What's up, audit fans? Welcome to Amanda Loves to Audit and the launch of my new series on accounting transaction cycles from an audit perspective. So what are we going to look at in this series? Well, for a range of different transaction cycles like sales and cash receipts, purchasing and accounts payable, payroll, property, plant and equipment, long-term liabilities, we're going to analyse what a traditional or typical process looks like in a range of different firms. Then we're going to look at the sorts of inherent and accounting risks that are going to arise. We're going to try and identify common control activities, how you test those controls, and different sorts of substantive procedures you could use. Why am I doing this? Well, I've had lots of requests for analysing transaction processes in depth and helping students develop some examples. Like my series on auditing standards, this is a really big undertaking. So this is not something that's going to happen in just a couple of weeks. It's going to take quite a long time to get through all the videos, but I look forward to making them and sharing them with you. So without further ado, let's get into it. So my video on sales is going to be broken into two parts. The first part is going to be about the process. What should we expect to see in a regular sales process in different types of companies? Then we're going to look at the common inherent risks and potential accounting risks of material misstatement. We'll also identify the control activities in today's video. However, in part 2 of this video, we're going to look at the types of tests of internal controls that we can do over the control activities that we identify, and also the type of substantive tests. Now, why have I broken it into 2 videos? Well, it'd just be too long for one specific video. So make sure you've got yourself a snack, a cup of tea, and I'm going to start drawing on my tablet right now. So let's try and understand that process related to sales, and we need to find out what exactly is happening. So there are the sorts of things that you're going to want to ask, or you're going to want to find out, are about what sort of product does the entity sell? Is it something big? Is it something small? Is it a good? So I guess there's some issues there. We want to find out if it's a good or if it's a service. We need to find out if it's what I call a one-stage item, which means you buy it, you take it away straight then and there, or is it multi-staged? So that might mean that you buy something that has a number of different components, maybe it needs delivery later. So we need to think about what is the product and how do they sell it? How is it sold to the customer? So once you've figured out the product, then you need to think about the payment. All right, so how do people pay? Is it a retail operation where it's cash and credit cards? So that's likely to be retail. Or is it more wholesale where people are likely to purchase on credit or on account? And that on credit or on account is that accounts receivable process that a lot of wholesalers, manufacturers will use. Because remember, there are different processes. If we do have credit, then there are going to be questions about exactly who receives credit and what is the approval process. So do we need to look at bank statements? Do we give everybody a generic approval process or some sort of generic, everybody gets $50,000 worth of credit straight away? And then you also need to think about payment terms. So when it comes to payment terms, it might be that you have to pay within 30 days, within 60 days. Do you get a discount if you pay early? So payment is really important. Now, the next thing we need to consider is also going to be delivery. How do customers actually receive their goods? Is it that they take it with them? Oops, can't spell there. Take it with them. Or is there delivery? Now, when you have delivery, you need to think about 2 specific things. Number 1, who does the delivery? Is it the client with their own trucks or delivery service, or do they contract some sort of courier company or delivery company. Now, this is all important because if they deliver it themselves, then how do we account for those costs? If it's a courier company, then when it comes time to audit expenses, we know we need to look for those doing the audit. The next thing that I typically think about when I'm analyzing a sales process is the sales people. So how are sales made? Are sales made online? Are they made with salespeople? If they're made with salespeople, then we want to ask questions about how are they paid or remunerated? Because if they're paid with a salary, so they get a fixed amount per year, or an hourly wage, then we don't need to think about whether their pay affects sales. However, if they also receive some commissions, we know this increases our risk of material misstatement, and I'll explain more on that later. And then the last one, do they receive some sort of bonus? Again, bonuses are going to impact how they might manipulate sales, accounts receivable, or cash to meet particular bonus targets. It increases the risk. So when we're thinking about a sales process, how is the sale made? I forgot to add up here, is it a good or a service? Is it something that perhaps is delivered online as well? So we need to think about the product, the payment, the delivery, and the salespeople to be able to understand the process. Because remember, retail is going to be different from wholesale. So next up, let's map out a quick flow diagram or flow chart of what a process might look like. I'm going to switch to a slightly smaller pen because we're going to need to fit quite a lot here on the page. So imagine we've got a start point, okay? Now here, let's talk about sales in a retail environment. So let's say sales, retail here, okay? So in a retail situation, you have your customer comes in, they pick up the item, it needs to be purchased. So what sort of process, what might we see? Well, customer selects item. Oh, I'm going to run out of room here. So they've selected the item. It needs to be barcode scanned. All right, so scan barcode of the item. Now, when you scan that barcode, that's going to bring in a control activity, and the barcode acts as a control activity itself. So you're going to have some sort of computer price list. All right, so you're going to scan all your items. Then the system is going to calculate the total for the sale. All right, so it's going to add everything up. That also acts as an internal control process. Now here I'm going to add a payment process. So payment type. Now let's say if it's cash, then they receive cash and give change. All right, and that's probably at some point going to update my accounting system, right? Some sort of point of sale system. So they're going to have to enter the cash and receive the change. Now, if it's a credit card, there'll be a process here to charge the credit card. So regardless of which payment method we have, there's going to be a process to generate a receipt. All right, so we have to generate a receipt. I'm going to shift this flow chart up a little bit so I can keep writing. The receipt's going to come from that accounting system. If we charge the credit card, that's information's going into the accounting system as well. I've got some lines crossing over here. It's not exactly the neatest flow chart. That's going to give us a little document receipt, and that's going to go to the customer. Okay, so in this process, let me try and show it all on one page here. I'm going to highlight the activities where there is an internal control, okay? So scanning the barcode, that's an internal control. We've got the price list, acts as an internal control. The system automatically calculates the total sales, that's a control. That we have to generate a receipt and then it updates the accounting, that's going to be a control as well. Now, if you think about your supermarket, there might also be some process where you have to deactivate an RFID tracker on an item if it's an electronics store or you're selling something quite expensive. But this is the sort of process that you might see in some sort of sales environment. Now, also, I didn't add up here that prior to when the customer scans the item, there might also be a step, depending on the business, about the salesperson scans their ID. All right, that could be in there as an extra control to make sure that you know exactly who is selling or who is using the cash register at that specific time. So that's an example for retail. Let's look at an example for a wholesale environment. All right, so let's say in a wholesale environment, the customer places an order via the website. Okay, so let's say here, order via the website. Okay, so they've placed an order into our system. Let's say this is the point of sale or the web system, so POS or a web system. Then what happens typically is that there will need to be, let's not do that as a square, let's do a credit limit check. So we need to figure out for how much they owe. Do they still have money to be able to spend on account? So if they've exceeded the limit, we're going to need to send something denying the order. If they have cash to spare, so they are within the limit, then we can order or process the sale. Okay, so there's going to need some sort of process there. Now, processing the sale means that now we need to organize something happening in our warehouse. I'm going to draw a line here because this is in the warehouse. So we're going to process the sale by entering the details here, or print the order details. So from this system, they're going to print the order details, and generally they generate something called a pick list or a pack list. So that says for this order, here are the 5 items that need to be collected off the shelves that are going into this transaction. So there's going to be a manual process where somebody has to go off and collect the order items. All right. And then as they collect them, hopefully they're marking them off the pick list at the same time. So what needs to happen is once they've collected all the items, let's write this here, items match the pick list. All right. If no, then they need to go back and they need to figure out, what am I missing? But if they have all the items, yes, they can probably box everything up, attach label to the box. So there has to be some sort of label that's generated so that it knows where to go for delivery. And then probably in the system, mark the order as ready for delivery. All right, so in the accounting system somewhere, or the delivery or the inventory management system, we have to mark that as an order ready for delivery. Then we have to go out and deliver the item. So I'm going to run out of room here. So I'm going to do delivery down here. So imagine they have their own delivery drivers in-house. So the driver is going to deliver the item. Now, typically when you receive a delivery, you also need to have a signature. So they're going to need to obtain customer signature. Now, that could be, oh, I've got that as a manual process there. Let me just make that an online process, because it could be signing on a tablet, which again is going to update that system to say that the item is delivered. Now, once it's delivered, then automatically what should happen is also some journal entries. Okay, so we should automatically have journal entries, and that journal entry would be to go debit accounts receivable, credit, sales. And we know that that has to happen there because that's the delivery point. So that's the accounting standard rules. And then there will be a process later where at the end of the month, you say to the customer, here is what you owe and here is what is to be collected. Now, I just realized back in our examples for our retail entity, we didn't talk about where journal entries would be made. So generally, we would make the journal entry after we generate the receipt. There would also be a process to create the automatic journal there. And so that's going to be debit cash or money owed from the credit card, credit sales revenue. So that's pretty much the process that we expect to see. So what we need to do next is think about our accounting issues. Okay, and I mentioned one of those briefly before, and the first one is recognition of revenue. So remember that the goods cannot be recognized as revenue until they've been delivered to the customer. So a lot of businesses will say they can recognize the revenue as soon as they've given the parcel over to Australia Post, for example. But technically, they don't earn that revenue until the article has been delivered. So we know that we have an issue around the recognition of revenue. And in terms of assertions, that's going to affect our cutoff assertion, recognizing revenue in the correct period. Now, if there are sales commissions, we know that, and actually, let's take this from an assertion perspective. Let's look at our assertions. Occurrence, accuracy, couldn't spell it there for a minute. Classification, completeness, and cutoff. Okay, so these are our assertions relating to the sales account because this is a transaction account. We need to think about what are the risks associated with this specific account. So we're more worried about overstatement of accounts like sales because people are more likely to overstate revenue. So we're worried about occurrence. Could there be any reason for there to be fake sales or overstatement of sales? And that is most likely related to bonuses or commissions. I can't write here today. Or sales targets. So that's going to be a big one. Accuracy is, have we charged our customers the correct amount? So this is often going to be related to barcodes and scanning and price lists. Is there any way that people can override the price? If there is a price override, who approves it? Is there a manager? Classification is going to be our journal entries. So that's going to be related to, do we have any risk in how the journal entries are processed, set up for the specific account? So how is the accounting system set up? What are the default journal entries? Are those journal entries correct? Completeness is, we're worried about understatement of sales. That's unlikely everywhere unless you're trying to receive a government supplement for low business performance at the moment. So when would a company be likely to understate sales? So we have to investigate whether there are any issues about the entity or the environment that would encourage understatement. And then cutoff. And cutoff is one of those ones that is typically related to delivery, we could have mistakes, or companies potentially recognizing sales when the order is placed, not when the goods are delivered. And that's a really common one if you're trying to bring sales into this period. Alternatively, companies might be trying to push sales into the next period if they've already reached their sales targets. So we need to look at our accounting process and go to the client, interview them, find out the process, and see if there are any indications that we might have issues related to these assertions. So that's the end of our first video in this series. I've talked about sales, I've talked about the sorts of controls that we might want to see, and I've talked about the potential accounting issues. What we're going to do in our next video in this series is actually look at the process of how do I test those control activities, and then also how do I gather substantive evidence. Of course, if you thought the video was useful, I'd love for you to give me a thumbs up. Please consider subscribing to make sure that you get all the videos in the series, and check out all of my other work on auditing and my webpage on amandalovestoaudit.com. There's lots of resources there to help students and to help you brush up on your audit knowledge. Thanks for watching, and I'll see you next time.